Good afternoon, and thank you for coming to my YouTube channel. Today is June 24th. It's 4:30 Eastern Time, and I want to talk to you about that GDP. Most people don't even know what the GDP is, but I'll explain. The GDP is defined by all the consumption we do in dollar value with finished goods, household consumption, investment by businesses, purchase by government. It indicates the economic health, but more important than economic health is our living standard, and that's the key. So today we're at 0.2%. 0.2. That means we're negative. We are negative. And on an annualized basis, we'll be probably about 1.8%. Horrible. And that's when we got, and remember, all this money we had from going into QE. We had all the money coming into our stock market, the 750 billion TARP, remember that one? And then we got about 250 of that when Obama took over, was his 250. Then Obama put the 850 in. That was the stimulus. Unfortunately, most of that stimulus money went to all his Democrat friends in the states, where they were able to use the money to expand the unemployment from 26 weeks to 72 weeks. Then the banks didn't quite have enough money, so they secretly gave them 1.7 trillion on top of that in the bank. This is all QE, okay? This was TARP. This is QE. This is QE. So we've had a lot of money coming in here. Then remember, another 3 trillion was QE money, went into the stock market. The 3 trillion right into stocks. And then we had another almost 2 trillion that went into stock buybacks, went to companies. All of that money, stock buybacks, all of that money, okay, and some other money, there's about 10 trillion total, okay, and we have a GDP that's flat, or let's say annualized, it was 1.9%. That is pathetic. So, okay. So what is going on, and what's going on with the market? Okay, first of all, let me draw the stock market right here. This is the stock market. Right, this is the dollar. This is the 10-year Treasury. We're at 2.4%. That's the yield. So here's what's going on. She has been saying, yelling, that I'm going to raise interest rates because the economy is doing good. Her narrative and his first was when inflation was at 10%, they said we're going to drop it to 5.2%. And when we get to 5.2%, there'll be so many jobs that the companies will be bidding for people, and their wages will be going sky high. And to cover their increased wages to try to get the help, because we're going to be bidding for them, they're going to raise the prices of their goods and services. So we're going to have to raise our rate to calm this down. Now, in the meantime, every time she said that, from last June, remember, she started last June, all started in the last June, and went up for a year until this June, and then finally in June, she admitted she wasn't going to raise rates, right? Even though we're at 5.4%, very close to the 5.2%, her target. That's when people started to get a little upset, and then she said, I'm going to move it to September, and then people started to sell off the stock market. Now, let me explain. People come in from Europe, and they buy into her lie that the economy is doing great. And how do they judge the economy doing great? By increased interest rates. That's right. On what? On the Fed money. On the Fed money. That's the money that they loan overnight. That's the money they loan to your bank. Think of it that way. Fed money, they loan it to your bank, okay, to your bank, and then the bank loans it to you. So that goes to your bank, and that will be what you pay. The rate they set will be on your adjustable rate mortgage, right? Adjustable rate mortgage, your credit cards, your student loan, your car loan, and also your business loan, okay? Car loan and your business loan. So that's quite a part of the economy, isn't it? Yeah. So that's your business loan. So that is very serious when they raise not this rate, but her rate, called the Fed rate. Okay, and I'll put it in this color here. We use this color here. How about we'll call this the Fed rate right here. Okay, the Fed rate. That'll be the Fed rate. This is the rate on the 10-year Treasury right here. That's the 10-year Treasury. All right, so let's think of it this way. So here's what they do. They come in from Europe to buy our stock market over here. Those are stocks. Or to buy the 10-year Treasury, which what you're doing on the 10-year Treasury, you're giving money to the bank. You're loaning money to the bank. So Europeans come in, the Saudis come in, and China comes in, and they got to change their currency because you can't buy stocks or bonds with yuan or anything else. So they come in exchange for dollars. Now, when the dollar goes up, that creates a problem. Okay, when the dollar goes up, that also means stocks start getting hurt. That means like Caterpillar and all your Dow 30 stocks, the big stocks, Caterpillar, Johnson & Johnson, all the big stocks that do a lot of their business overseas, they get hit hard, okay? So their earnings come down, and that's why a lot of our earnings growth has just slumped, okay, to where we're at an earnings growth right now of 0.02. because we're negative 0.02. Because when you have the dollar going up, these people are having trouble selling. But also when the dollar goes up, why is the dollar going up? Because they're buying dollars to buy what? The bond. They want to invest for 10 years and sock away money at 2.4%. So they think they're pretty clever, 2.4%, the Chinese and everybody. And they're going to put the money into the Treasury, and they leave it there for 10 years at 2.4%. But as this interest rate goes up to here, and now why did it go up? And because remember, they didn't think their European country was going to do well, their economy, because she lied and said the Fed rate's going to go up. And anytime Fed rate goes up, that means excellent economy in the United States. So bell goes off. So they dump their euros or whatever, buy the dollar to buy the Treasury, and they also buy stocks too. So just know that this is not good. When the yield goes up, that's interest. Why is this bad? This interest is different from here. This interest, remember, is what the government pays. They pay 2.4% when they borrow money. That is not good. And all our home mortgages, fixed rate mortgages, are tied to this. And our whole country, remember, is based on real estate. That's all we do is buy homes, right? So that's not very good. So if you're going to pay 2.4%, you better have an economy growing, a GDP. If you're going to be paying 2.4%, you need an economy. GDP of growing at least 5%. GDP, okay, let's say GDP of 5%. That's what you need if you're going to have interest at 2.4, almost double. We don't have that. We have a negative 0.02. So that's not good. Very bad, isn't it? So here's the point. Where we are now is the stock market has been going up at 30% a year, even though our earnings have been coming down. Our earnings have been coming down by 5% to 8%. Today it shows our corporate earnings have dropped by 8%. So our corporate earnings are down 8%, minus 8%. Wow, we dropped 8% corporate earnings. But that has nothing new. So how's the stock market go up when all through here our earnings were coming down? Well, that's what QE is about, okay, QE. And why we're going to have another QE. What QE does is it fills three functions. One, okay, function is to print money. Okay, you're going to print money over here, and they're going to go and they're going to buy the 10-year Treasury. The Yellen, okay, is going to print money and try to get this interest rate down so she can get the stock market keep going up. All right, so to cover the bad economy. So this drops down to 1.4% down here. And that 1.4% now, how they get down there? Remember, she printed money. Okay, she's got the money machine. She's printing it. She buys it. Normally, China and the Saudis would switch to dollars and buy the 10-year Treasury, loan the money to the Treasury at 2.4%. So the reason why she knows that the economy is bad, she'll print it, she'll buy it first, drop it down to 1.4%. So when they come in, they take a look at it and go, "Oh my God, that's pretty bad. we're not going to go ahead. It's too unattractive. So the Saudis, everybody looks at 1.4%. So where do they put their money? Instead, they shift their money over to here. And that's her idea. When the economy is good, the economy is not growing, then at least get the stock market to go up. Okay, so that's number one. QE number one, okay, is to print money, okay, to drop the yield down. That's QE, okay? That's the one thing that they do is they print money to drop the yield. So we'll just say interest, okay, INT. So the interest rate down. That's the first thing. Now the second thing they do, the QE does, is take $3 trillion and decide to pump that directly into the stock market. So they print it and they put it into the stock market. Okay, and that stock market keeps going up because they print money to buy stocks. That pushes up. Now, in the meantime, remember, our earnings aren't going up at all. Company profits aren't going up, but stocks are going up 30% a year by doing this. It's called QE. Now they want to move the stock market up more because they don't keep doing this. It's like a shark. All of a sudden, it'll stop swimming and die. It's the same thing with the market. When you create a fake stock market, you got to keep pumping money in. So then we got number one, number three. Okay, number two, of course, I said is number one is you drop the yield down by printing enough money to buy the 10-year treasury to drop it to 1.4. So that means all these guys then switch from buying treasuries into the market and moves it up. They also print money, okay, to put in to the companies 1.8 million. So think about that, 1.8 trillion. So at 1.8 trillion, okay, they print 1.8 trillion and they give it to who? They give it to the companies at 0% to buy their own shares. So that money goes in there. So here goes the money to here. All right. So now that's the 1.8 trillion to buy their own shares. So now think about it. What is QE? QE is to drop the yields down to shift China, the Saudis, and everybody else out of the stock market, out of the bond market, into stocks. Next, she prints money, okay, $3 trillion to pump the stock market up even more. Then she prints money for 1.8 for stock buybacks so that their stock prices go up even more. Now, that's what we've been doing. Now, when that all stops, what happened? Our stock market, all of a sudden, it stopped. We're not going up 30% anymore, are we? No. So now we've stopped dead. So we haven't gone up 30% this year because it's the first year we haven't had QE. So it hasn't gone up 30%. So we're stuck up here. We can't break out because interest rates are too high. So what's going to happen? This winter, we got to import oil. Because why? We need to import oil because 40% of our oil right here comes from overseas. So we got to pay for this oil. How do we pay for the oil? We got to go to the Saudis. Well, wait a minute. The Saudis are over here, and everybody else, right? They're in the bond market. So what we're going to do is we're going to, again, now that we stopped QE, remember we're back up to 2.4%. So this fall, when oil comes, they're going to play this game over, do QE again. Same thing again. One, go in and she's going to print money and buy this 10-year treasury, dropping it down to 1.4%, so that Saudis and the Chinese and whatever see it's unattractive. So, and what they're going to do is we got to borrow money, but we're going to borrow money at 1.4%. Remember, they not only borrow money from China, they borrow from other countries, and they borrow it from us. But so that's why they want to get it down, because when this oil, they start shipping it into the fall here, they can't pay that kind of interest. So once this comes down, what's going to happen to the stock market? That's when the stock market is going to take off. The market will finally break out and run. So that's why we're going to get QE, another QE, okay? QE4. So that's the story. We will have QE4 this fall when we start buying oil because the government can't pay 2.4% interest on the money they got to borrow to pay for the oil. In the meantime, we're stuck right here, right? So what do? Well, when you're a gang member, we do very nicely. We trade within this range, that's all. And with our charting, we know how to do it. I hope this explains to you why today, on June 24th, the GDP of a negative 2%, 0.2% is so serious and so bad. Okay? But at least you know one thing, look forward. We are going to get the yields back down to 1.4. That's why they got to do QE4. And when that happens, the stock market will break out. That's how they're going to get the breakout. See you on the chart. Join my gang, philsgang.com.